Hello, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. We got another great topic and discussion for you today, but before we get to the show, I want to remind everybody to jump over to Apple Podcasts, Google Podcasts, and Spotify. Make sure to subscribe to the show and also download today's episode. And if you like what you're hearing, please make sure to leave us a written rating and review. We really appreciate your feedback. Also, if you'd like to connect with us, check us out on our meetup page on Facebook. You can check us out at South Texas Multifamily and More Facebook group. You can connect with us via LinkedIn, and you can also follow us on Instagram. And if you'd like to learn more about me and John and Blue Oak Capital, check us out at www.blueoakinvest.com. So with that, John, good evening. How are we doing?
How's it going, man? I just put the kids down. I'm ready to rock. Sarry's with us today. I'm excited to talk about this specific topic. I think everybody's going to everybody's kind of in for a treat. For those of you that don't know what bank on yourself is or investing with certain policies, this is the kind of the educational event we're going to have for you. So Sarry Ibrahim's with us. He's a financial professional. He's a member of the Bank on Yourself organization, and this concept will actually change the way you think about how you your relationship with banks and having money in your control versus others' control. But Sarry's been a great help to real estate investors, business owners, full-time employees to help them all create their own sources of financing while also growing safe and predictable wealth all at the same time with the same money. So I'm excited to get into this topic. Sarry, thanks for being with us.
Hey guys, thanks for having me on. I appreciate it.
Yeah, man, absolutely. As John said, looking forward to this conversation. As real estate investors, we're always looking for not only asset protection, but also ways that we can get creative in how we can build capital and leverage that capital to continue our investing. So looking forward to learning more from you and the Bank on Yourself philosophy. So tell us a little bit more about your background and how you got into the financial world.
Yeah, definitely. So I've been a licensed insurance professional for about 5 years, and I pretty much was a Medicare specialist. I only did, for the most part, Medicare. And one of my clients asked me to look into life insurance for him. And I didn't really know, I had my life insurance license, but I didn't really know much about life insurance. So I told him I would do research and get back to him. And I started doing research, and I noticed there was different types of life insurance. And one of the ways I like to learn is I like to read books. So I went to Amazon and just started searching for books on life insurance. And I came across a book called The Bank on Yourself Revolution by Pamela Yellen, and read the book and really liked it. Both as an agent and as a consumer or client. I like the book. And the book pretty much talks about using cash value life insurance for you to become your own source of financing while also growing guaranteed wealth with also tax benefits too of growing that guaranteed wealth. And kind of for the listeners who aren't really aware of whole life insurance, it pretty much has like two main functions. It has the life insurance part, like the death benefit, and then it also has the cash value part. The cash value part of the whole life insurance policy is what makes it the Bank on Yourself method. That's what the Bank on Yourself concept mainly focuses on, is the cash part of the whole life policy. And I'll definitely get into more of that as we progress in this episode.
Hey, that's great. Thanks for the overview. Now, you may have blown some people's minds when you said that and some of the jargon. So kind of step us way back, and then we'll fast forward back into the topic. And I'll just give people a intro on this. I first came into this concept about kind of banking on yourself with a cash value life insurance policy from a book written by Nelson Nash. I think he wrote it in 2000. It's called Becoming Your Own Banker. And it's really, it's kind of taking the control back into your own control. And so this concept's really powerful, but could you break this concept down of borrowing from a cash value from an insurance policy? Like what's the breakthrough of that versus, traditional banking?
Definitely. So in order for this whole infinite banking, and by the way, infinite banking is the same as Bank on Yourself. They're just two different trademarks. That's it. But it's just the underlying product is a whole life insurance policy. Now, for this to work, it has to be whole life insurance. It can't work with universal or term. It has to be whole life. And then it also has to be from a mutual insurance company. So a mutual as opposed to stock owned. mutual insurance companies give dividends or profits back to the policy owners. So the cash value part of the policy will earn dividends over the years, and that's one of the ways the policy grows. It also earns interest from the insurance company because the insurance company, like other investment or financial institutions, they're using money to grow, right? They're investing in the bond market and in real estate markets, and they're earning dividends and interest, and they give those back to the policy owners in their cash value part. So it has to be mutual. And then over the years, when you build up the cash value in the whole life policy, you have access to it via loan. So you can access the policy, borrow from the policy, and then pay yourself back on your own terms. It's not like other financing where you have to meet certain terms. And if you miss those terms, you can face penalties or like a hit on your credit score or things like that. This is like a personal loan from the insurance company, but on your own terms. And to kind of give you guys a more specific example, think of for example, let's say that you have $100,000 in cash value in your life insurance policy. That means the cash value is $100,000. And let's say you come across a real estate deal that requires you to invest $50,000 in cash into the deal. Now you go to your policy and you borrow $50,000 from the insurance company, but you're not deducting $50,000 from the $100,000. The $100,000 remains the same, but you're borrowing $50,000 from the insurance company. And then let's say you pay it back over 5 years, and it is a loan from the insurance company. So there is simple interest involved. And let's say that you use a simple interest rate of 5% back to the insurance company, and you pay it back over 5 years. Let's say you paid it back like $53,000 principal and interest back to the insurance company. Now you're probably wondering, why would you pay interest on your own money? And the reason why is because on your $100,000 cash value, it never changed, it never reduced. It actually kept increasing over the years and kept earning dividends and interest. And after like 5 years, for example, these aren't specific numbers, but just for example, after 5 years, you may have reached like $65,000 in addition to your policy, but you only paid $53,000 back. So there was like an arbitrage of $12,000, meaning your policy the growth of your policy outpaced what you borrowed at. And by that rationale, it's better to use the policy than to use your own cash, because if you use your own cash for deals, you no longer can earn interest on that cash anymore. So you're essentially trading your cash for other investments. With the bank on yourself concept or the infinite banking concept, you have the ability to do both. You can recoup the interest you would have earned while also participating in investments. Your money is not locked away. It's not an either or product. It's not either I put my money into whole life insurance or I put it into the real estate or I put it into the stock market. I can kind of integrate all those things together on your own terms.
Yeah, perfect. So what you've described is, and I'll use your $100,000 example. I've got $100,000. I take out a whole life policy with a mutual insurance company, right? And that's different than a stock insurance company like AIG. So you're talking like more of like a Northwestern Mutual or something like that versus AIG, publicly traded, because I believe those are owned by the policyholders. Is that how that works?
Yeah, mutual is owned by the policy owners.
Yeah. So, okay. So the incentives are aligned. So anyways, you take that $100,000, you put that into a whole life policy with a mutual insurance company. Let's just say that $100,000, ballpark, it's, $80,000 after a couple of years of cash value. You can then borrow against that cash value. The $100,000 still is compounding with the returns of what Northwestern Mutual or whoever the mutual insurance company is investing in at the time, bonds, real estate, et cetera, and their investments. So you've still got the $100,000 compounding, so that hasn't changed. But you can take a loan out against the cash value part. So I'm just assuming $80,000 or something like that, and that's a simple interest, right? So it's not necessarily amortized, and you've got to pay back principal. It's interest only, and you've got full control of that. Correct. Am I describing that right?
Exactly correct. Yes.
Perfect.
Okay.
And so, go ahead, Cody.
Go ahead, make your point, because I have a question.
No problem. So my only question was, I first heard about this and I was like, oh, that's a really interesting concept. And that was like 2 months ago. This is in 2020. And it's certainly not, you got to keep spreading the message about this, but it gives you a lot more control in my mind Tell me the story about how you first came across this and kind of like how that really changed your mind and other people's minds when they actually started using it.
Yeah, the first thing that came to my mind was because I kind of had this like struggle, like, do I save my money? Do I invest it? Or do I use it right now? And it was kind of like hard to decide on which one of those things. And it is, I think for a lot of people, like it's hard for a lot of people, especially nowadays, to think like 20 or 30 years ahead from now. But when I started learning how you could save and use your money at the same time without interrupting that growth, that kind of made me look forward to like 20 or 30 years from now by being able to use the policy. So that was like the first thing that came to my mind, was the ability to save and invest and spend your money all at the same time, because you can like recycle your money. You don't have to choose either or products or either or services. You can recycle your money. And I think the whole point of making it banking on yourself, or the infinite part, is the fact that when you're borrowing your money, your policy is compounding and outpacing what you're borrowing at. That's, I think, the whole infinite part of this.
Sorry, let me ask you a question. Let's go back to the fundamentals of the policy itself. For those who may not have any idea of what a whole life policy or insurance is, how does that cash value accumulate? Where does that come from?
Yeah, exactly. So the cash value of a part of the policy earns interest from the insurance company. The interest can be guaranteed. It can be projected and guaranteed. The dividends are not guaranteed. However, we only represent insurance companies that have been paying dividends for over 160 years, including the Great Depression, the recession, and right now with the effects of the coronavirus in the stock market, the insurance companies have still been paying dividends. And then they get dividends from their investments in the bond market, in the real estate market. So they're so the policy owners are, in a sense, are like partners of the insurance company. So they're participating in the profits. And I hope that answers the question.
Yeah, I think that's very helpful. Like what kind of interest are we talking about? And, how is that, on average, what do the dividends look like on this? I mean, we're just trying to kind of get back everybody educated about kind of the money involved here, at least on the interest side, and then we can kind of go back on what do the loans look like, and then something we forgot, everybody, is the death benefit. This is obviously this is insurance, so there's a death benefit. Not that we want to focus on that, but that's also the benefit of the policy. So kind of what's the money on the interest on the compounding side and the dividends? What does that look like on average? And then also, what happens when we're taking out a loan? What's that look like?
Exactly. So on average, you're earning between, including dividends and interest, on average, you're earning between 4 and 5% compound every year. And then as far as the loans would be a simple interest rate of 5%. And as far as the death benefit, which is also really important to include, the death benefit in terms of taxes is tax-free. So, and the growth of the cash value is also tax deferred. That's pretty much a huge advantage of it, is also death benefit, but the tax-free or the tax deferred growth also is important too. The policy grows at a tax deferred basis, so you don't have to claim the gains on the policy as income taxes. Sure. And even if there are gains, you don't have to claim them. And in most situations, when you go to use the loans or withdrawals from the policy, those are also tax-free. Not in every situation, but you would have to pay taxes on that money first when depositing into the account. And then when you go to take that money out, again, even if there are gains, it could still be tax-free. So huge tax advantages as well as a death benefit in this situation.
And what happens, so theoretically, just talking about asset and asset protection and estate planning, well, does this, do the tax benefits, does that reset at death, and does that pass to your heirs? How does that work?
Yeah, so when you pass away, your estate or your beneficiaries, however you have it set up, or your trust, would get a tax-free death benefit of, let's say, $1 million. They would get a tax-free death benefit. The policy would then cancel out, and then the generation would continue then, and then they would, of course, invest it and get life insurance, and the ball would keep rolling. It depends exactly on what the estate plan is, but that's pretty much what happens. Death benefit kicks in, policy cancels or ends, and then it becomes like a tax-free rollover to the next generation.
Okay, so you've kind of got what we'd call in real estate, stepped up basis, um, right? So you don't necessarily you're not necessarily due for a whole lot of income tax if there's an event, a life event at the end of the policy. Okay, that's great.
So I want to put these pieces together for the listener. So let's say I have the $100,000 and I'm buying into the policy, right?
Yeah.
That gives it the $100,000 cash value. What about what if I don't have that amount of capital? Can I start small and build up? I mean, because if you compare this to other, like maybe a perm policy or something like that, right? A temporary policy.
Yeah.
You pay a monthly premium, but it's only going to yield you a smaller cash value. Is that correct?
So with term, there is no cash value at all. Yeah, it's just death benefit only. It's usually much cheaper, but it's just a death benefit. Now you can, to answer your original question, you can do this definitely at a smaller amount. I've done a policy at $300 a month. And what happens is the first year, the cash value is probably going to be pretty small. Like, for example, like I put in $3,600 a year, so $300 a month. And then year one, my cash value was like $1,800, so almost 50% cash value in year one. And then year two, I put another $3,600 a year in, and then the cash value was a little bit greater. It grew by like $2,000. But then years 3 and 4, it's projected to outpace what I'm paying into it. So that's like the point of it. It does take a process. And the way I look at it is kind of like I have my income and I have my expenses. How much can I grip in between that? And Nelson Nash mentions that in the book is you have money circulating, but you need the ability to capture that money that's circulating in your own account that's not affected by those external factors, but can still grip your money and still earn you interest. And I think that's really important too, is that it's more of a mindset shift. It's not necessarily like a over-the-counter product that one would just buy and has like an ROI attached to it. It's something that you apply. It takes discipline. It takes a couple years to actually like see the benefits of it, but it's a way to grip your money. It's a way for you to think like a bank. Banks actually use whole life insurance. About 80% of a bank's reserves or tier 1 capital is located in a whole life insurance policy because they earn compound interest in the policy. And then they loan out from the policy to credit cards, home mortgages, car loans, equity, lines of credit. So they earn interest from the customers and they earn interest in the whole life policy, both at the same time. And if things don't go in their favor, like something happens in the economy or the stock market and people default, they have their repossession or their collection processes, but they also keep earning interest in their policy. So there's no interruption in the growth of that policy. And I think it's important for consumers and for small business owners and real estate investors to think in that way. You don't necessarily need to be a large bank to do these things. You could be a small business owner, but I think the mindset of thinking like a bank is really important, especially nowadays.
Yeah.
I like the concept that you're not interrupting the compounding.
Mm-hmm.
Mm-hmm.
I think that's it's critical. I mean, okay, we're going to release this in probably a couple of weeks, but today the NASDAQ was down like 5%. Okay. We had a really good run, down 5%. And then, some people get scared and they're like, oh, I'm going to take my money out and then I'll wait and I'll put it back in or whatever. But, that kind of behavior stops compounding, especially when you're talking about investments in income producing or coupon generating investments. And so you never want to take the capital out, right? You want it to continue to compound on itself. And this is a kind of a key concept when it comes to banking on yourself for infinite banking.
Exactly. Mm-hmm.
Yeah, absolutely. And to your point, like we alluded to earlier, like as entrepreneurs, we're always seeking opportunities to get more creative in our ability to grow our businesses, right? Whether we structure the deals or in this case, how do we utilize capital that's at our disposal that we normally wouldn't think about? I think a lot of people just think about cash in the bank, and if you don't have cash in the bank, well, you don't have anything to invest. And so, this is such a great tool to add to your repertoire, if you will.
Yeah, no doubt. I mean, case study right now. I've got some cash in the bank, and I'm pretty sure it's in Chase. It's earning 0.0000001%. I'm sure.
And you have to pay taxes on that.
And I'm waiting. Well, yeah, the of the 0.01, but yeah, I'm not worried about that. But I want this. I'm actively looking at deploying this capital. But again, this cash and this whole life policy. Again, I can't just turn the knob on tomorrow and get all the access. But this is, like you said, a mindset shift. I put the money in. It takes a 1 or 2 years to kind of spool up, but now I can borrow against that. I'm not taking away from the compounding. And at worst, I'm basically net neutral on interest payments between compounding and the loan. And so, I don't know if anybody's tried to borrow a personal loan right now or what it looks like on auto, but it's kind of like prime plus 3%. So you're probably at least in best case scenario, 4 or 5% straight up versus this, you continue to compound your account at, let's just say 5%, and then you borrow at 5%. So you're kind of net neutral. And so that's by itself, that's a 4 or 5% spread between a traditional, personal loan versus the infinite banking concept.
Exactly.
Yeah.
That's cool, man. Hey, I like to hear personal stories. Tell me, do you have any stories about clients that, do you have any interesting stories about how they use this?
Yeah. So I have, kind of to give you guys an idea, more thorough example. I had a client, he sold his house. He got $400,000 in cash. He sold it. And then he bought a single premium whole life insurance policy. And this is pretty cool if you have the funds for this. It's just a one-time payment. You never have to worry about additional premiums again. And he instantly had a cash value of $375,000, and instantly right away
400
out of 400,000.
Wow.
And then instantly had a death benefit, a tax-free death benefit of $580,000 right away. This is day one. So this is really cool because he has the liquid now. He can borrow up to $375,000. And of course, if something happens to him, his beneficiary would get $580,000 tax-free. And he saw this as more beneficial in this situation than a CD or put in the bond market, because there is no death benefit and the growth of the policy is taxable in that sense with a CD or other like bond market account. But with the whole life policy side, he saw that 375, and now he's actually in the process of he's looking for other investments now, and he's going to be his own source of financing. So when he does come across that deal, he's pretty much going to be like his own mortgage, where he can go in, and he's treated as a cash buyer, by the way. So just to kind of clear that up, you're treated as a cash buyer, but you're borrowing from the insurance company. Lenders can use the cash value of a life insurance policy as collateral. So it's not like you're kind of stashing your money away that you can never use again. You can prove it as net worth or as collateral. So that's really cool too.
Nice. That's awesome. That's really cool. So so day one, he's got access to 94% of the cash that he put in. And this is a one-time premium. Is that what you're saying?
Correct.
All right. So he's got 94% of that. He can immediately take a loan out against that, day one, day two, to go do whatever he wants with it. In the meantime, that $400,000 is compounding at the 4 or 5% that we talked about.
Exactly. Yeah. And then you mentioned something good too, the whatever part, whatever you could do with it. That's really important too. There are no government restrictions on what you could do with the money. You don't have to open up a separate LLC that's different from you and hire a property manager to do your real estate. You can do it at whatever you want with the money. There's no government intervention with how you handle those funds. So that's pretty cool too for real estate investors.
How does that actually work? Do you, just mechanically, do I just go into the policy account, like I log online and I'm like, hey, I want to borrow $400,000, and I just click a few buttons and it shows up in my bank account? How does that work?
Yeah, so there's a form you would print out, or you can go online and fill it out. You would sign, you put your policy number, the amount you want up to. You could do 100% up to how much you can get. So if you put in 100%, they would send you 375, and they would ask you which bank account you want to send it to. And then you would put the routing and checking number, and then about 3 to 5 business days later, you would get those funds there, and then you can just make up your own terms. a separate form you would sign and say every month deduct, $2,000 out of this account every month for the next 5 years, or however you want to structure it to pay down that loan.
Nice. So you're telling me within 5 days I can get, I mean, in this case, $400,000 or 370, wired to my banking account, and I can just do whatever.
Yep, and then they would both, actually, the death benefit and the cash value would both compound every single year and grow, and eventually outpacing what you have in the loan. So your policy would outpace what you're paying in interest to the insurance company.
And so that's interesting too. I thought that the death benefit would not compound, but I assume it does even in this one-time premium. So that's compounding in addition to your cash value, the death benefit?
Exactly.
Oh,
yes.
Cool.
Yeah.
This is, it almost sounds too good to be true, right? I mean, it's just mind blowing to think that, you have this type of strategy that's so easily accessible and so beneficial in the ways that you discussed. There's got to be some cons to this, right? There's got to be some downside to this. So can you speak to some of those topics?
Yeah, definitely. So one downside is you need the capital first. So it's not like, magical money. You need the capital first. You do have to actually allocate it to the policy, and you can never borrow more than what you've put into it. So that's kind of one con. If you're in need of instant capital for real estate and you need more money than you actually have, then this probably won't be a good fit for you. If more capital than you have is a necessity to you, then this won't be really a good fit. Another con to this is the policy loan. You do have to pay that back within reasonable time. You don't want your loan balance to exceed your cash value. If that happens, then your policy can lapse. And I think that could happen if you just never pay back the loan. Eventually, your loan balance will increase because you're not paying anything back, and then it will exceed your cash value and the policy can lapse. So I guess those are the two cons to this: is the capital part, and you have to pay back the loan.
Now, when you mentioned pay back the loan in a quote unquote reasonable time, you mentioned earlier that, hey, you can really do this on your own terms. Is there any guidance from the policy servicer, if you will, that kind of can tell you, hey, look, you don't want to go past 5 years, or you don't want to go past 10 years, or whatever the case may be? What's that reasonable time frame look like?
Yeah, so the reasonable could match what you would if you were borrowing from another bank. For example, if the rule is with a credit card, you want to pay it back in a year. Car is 5 years. Mortgage is 30 years. Kind of those guidelines, those
Gotcha.
reasonable guidelines. But also too, we do have calculations for clients where we can calculate the longest time it will take them to pay back the loan without the policy lapsing. So if we actually had the numbers, we could do the math for clients to give them an idea of you have X amount of time to pay back the loan without the policy lapsing.
So you're back calculating kind of the maximum forbearance period of that loan.
Yeah.
And I would like to say, this sounds really flexible because, you miss a payment or two on any other loan, you got problems.
Exactly.
Okay, so let's dial back a little bit because I had a few more questions as we were kind of going through this. So how much can I contribute to the policy premium per year? Because I know other types of policies have caps on them, right? So is there any restrictions on that for this?
Yeah, you can. Okay, so you can technically do you can make the death benefit 25 times your income. So if you make $100,000 a year, that's, I think, 2.5 million, right? If I'm not mistaken. Yeah, 2.5 million death benefit, which would be a pretty, it depends on the age and the company and the state, but you could pretty much allocate up to 25 times what you make. That's your cap for the death benefit.
Mm-hmm.
Minimum, we've seen, they usually you can't really get that much compound interest if it's under $300 a month. That's kind of the minimum. And there really is no maximum. Banks use these policies. Banks would put in $20 billion at a time in these policies. So there really is no max or cap to fund the policy.
Nice.
And by the way, Cody, I'm just throwing this out there. This is, when we look at multifamily lending, we obviously have the traditional lenders, but we also have a tier for life insurance. And that's got to clearly be where a lot of this capital is going into.
Mm-hmm.
Maybe in some of the higher class assets, probably not C class assets or anything like that. But there's a very clear tier that is on the lending side and the life insurance piece. So it's really interesting to see how this kind of comes full circle on the real estate side.
Yeah, I was exactly thinking that, because I mean, every time we talk about institutional money, that's that's definitely falls into that umbrella for sure.
Right.
Nice. And I like the fact too, what you pointed out, and I hope the listeners caught on to it, because as real estate investors, especially on the active side, as we're raising capital from others, if people are utilizing this strategy, there's no, if I'm interpreting this correctly, there's really no need to go through any special, legal structuring, if you will, as far as partnerships go, right? Because I'm taking the loan out to me, the person, and then that person is using it to invest in whatever they want to. So it's not like I'm investing with another LLC, for example, that or tenant in common, maybe that, with the self-directed, not self-directed, or 1031 exchange, that would require a certain type of legal entity structuring, right?
Exactly. Yes. Yep.
Yeah. So it's like John said, it's very, very flexible in what, you can do from an investor side.
Yeah. I mean, this allows you to have flexibility. Now, it doesn't allow you not to be disciplined. Right. You can't be reckless with this, just like you can't. I mean, I guess you can be reckless with money, but I mean, you've got to have some discipline. So if somebody's, a client that's like, hey, I'm not disciplined at all, I've been bankrupt 3-4 times, you're like, well, maybe this is not the right fit for you.
Yeah.
But it offers, if you're disciplined in any reasonable amount, this offers you the max flexibility. And I will say, guys, the 10-year treasuries at 0.7%, maybe lower. And, you get nothing in your bank account. All right. So everybody's heard of TINA. There is no alternative. Well, this sounds like a reasonable alternative for those of you that are holding a ton of cash right now. And I know there's a bunch of you out there because I talked to you. And this is an interesting way, especially if you don't have any kind of material death benefits for your family. You've got a couple of kids. So, if you're holding on to $100,000 in your Chase Bank and getting zero on it, this is an interesting model, and then what you can then borrow against and get the death benefit. So it's really interesting. And now keep me straight here. I'm not paying taxes on these dividends. So this is not classified as income.
Correct. Yes.
All right. So I think there's an after-tax, conversation you have to have with yourself of, do I put this in a, utility stock that's paying 4% or whatever? Well, yeah, hey, that's regular income, man. You're paying taxes on that. So, all this comes into consideration on the after-tax effects of this policy versus something that would be taxed.
Yeah.
Correct.
This is cool.
John, I want you to know, by the way, we're going to find a way to get Tina in the title of this podcast episode.
There is no alternative. And FOMO. Nobody had FOMO today. I tell you that. They're like, ooh, bad. Hey, Sarry, tell me, I keep going on this story thing. I like to hear these examples of your clients. So do you have any other kind of, interesting tax stories or maybe something on the death benefits that's kind of been interesting? Just curious.
Yeah, definitely. So I'm thinking, I had another, speaking of the single premium one, another one. This is pretty cool for those who don't have $400,000 but have a smaller amount and still want to participate. I had one client, he put in a single premium of $20,000. So it was just one time $20,000. And he had the ability to borrow up to $20,000 right away from day one. And he had a death benefit of like $50,000. So that's really good too. And you also have the ability to add in money freely, just like a savings account or checking account, up to $250,000 a year. So that's really good for two reasons. One, there's no, it's not 400,000, it's only 20,000, and there's no commitment for more premiums. And also it's very flexible in terms of overfunding it and also underfunding it. So that was actually really cool too. I actually might do one of those soon, a 20,000 just single premium policy with the ability to add more money in and take money out freely. That one I really like too.
Well, so what do you mean by take money out? You mean the loan?
Yeah, loan. Sorry.
Yeah.
So
Okay.
you
Yeah. Sure. Sure.
borrow.
Sure.
Yeah.
Okay. So to get a little bit more specific on that one, this is a policy that's got a single upfront large premium, and then it has a paid up additions rider. Is that what it is?
Yeah, yeah. I'm glad you mentioned the paid up additions rider. So,
And please educate us on that one.
yeah, yeah, for sure. So let's take it a step back. So, like for example, a lot of people don't like whole life insurance because they think that the cash value takes like 10 years just to build up a little bit, and they think that locking up that much money is a loss of opportunity cost. But they're actually referring to, and that could be true because they're referring to policies that are old fashioned and don't have the paid up additions rider. So imagine you are building a house and you have the foundation, right, of the house, and then you have the exterior structure on top of the base. If you were to build a house that was 2,000 square feet, but entire foundation, you would have just a huge basement and nothing up top. That's how the old policies are structured. You're putting in all that money towards the base, towards like the foundation of the policy, and you won't have anything to show for it. But if the policy is properly structured, if you can allocate like 50-50, so like 1,000 square feet on the bottom and then 1,000 square feet on top, you still have 2,000 square feet now, but it's structured differently. Same thing with the policy. You can have, for example, if you put in $10,000 a year, instead of all that going to base, you could do like a 50-50 split. So half of it goes towards the base and the other half goes towards the paid up additions rider. The paid up additions rider is mainly the cash part of the policy. It's also what turbocharges the cash value. You still need the base. You can't do 100% paid up additions. You still need the base for IRS purposes and tax purposes, but you do need that healthy balance between the paid up additions rider and the base. And the paid up additions rider is how you can see that like 50% growth in the first year of the cash value and the continuing growth and eventually the policy outpacing what you're paying into the policy
Sure.
from the paid up additions rider.
Yeah,
So
I like that. I mean, so you're putting in, and this is a little bit more accessible for everybody versus the $400,000 example.
Yeah.
So, I put $30,000 in one time,
Yep.
and then at my discretion, as I'm saving, as everybody should be, I can be putting money in that via a paid up additions rider,
Correct.
which will be kind of juicing the cash value in addition to that. But again, it's my discretion, so that comes back to the flexibility on these policies.
Exactly, and because a lot of real estate investors don't really have like base salaries, they have kind of sometimes unpredictable like wealth or income. They could allocate it based on, for example, like every deal you make, you put like 10% in. So it can fluctuate then because every deal is going to have a different profit margin. So this is really good for commission only or like self-employed or real estate investors.
awesome. And you kind of alluded to it. So you basically can't just go anywhere to get these type of policies, right? I mean, I can't just call up my local insurance agent and say, hey, I want, you have to have somebody like yourself that understands this specific type of whole life policy, correct?
Exactly. Yeah. Yeah. It has to be mutual. It has to be properly structured with the paid up additions rider and the base. It also, one important thing too, guys, is that it has to have a non-direct recognition loan feature. What that means is back to that example of the $100,000. If the company has that feature, the non-direct recognition feature, it means that when you borrowed that $50,000, for example, your $100,000 grows and compounds as if you didn't touch it. But some companies are direct recognition, and meaning that when you do go to access that money via loan, they'll reduce the dividends and interest to you because of your outstanding loan. So it has to be non-direct recognition, which narrows it down to like really right now, nowadays, maybe like 5 mutual insurance companies that you could actually do all of these things with.
All right, so let's recap that just for everybody. Non-direct recognition, paid up additions, and then I'll just say the kind of upfront premium, one-time premium injection. I would say that would be a nice policy for a lot of people. One-time premium, paid up additions, non-direct recognition.
Yep.
Does that sound right? Cool.
Yeah.
Yeah.
From a mutual insurance company.
From a mutual insurance company. So right now, and you said there's only 5. I mean, that would meet that criteria. And I assume you're filtering out all the ones that have only been around for, only 80 years or something.
Yep.
Awesome, man. So, Sarah, do you have any type of like educational information or like questionnaire that you can give out to people who may be just getting exposed to this? Like, so if they're, after they've listened to the show, if they want to maybe investigate this further, but, still may not kind of put all the pieces together, there's something that like a list of questions that we could provide to them that way they could be better well-versed in having this conversation?
Yeah, definitely. I do have, and just to be clear, you're asking, is there somewhere they can go to learn more about this?
It's education. Yeah.
Yeah, so definitely on my website, finassetprotection.com. There's other podcasts and other YouTube videos I've done that have more information. Plus, I would definitely recommend the book, Becoming Your Own Banker by Nelson Nash, as well as the book, Bank on Yourself by Pamela Yellen. And then also, if you just Google search like infinite banking concept or bank on yourself, you also get a lot of valuable information there. And I definitely recommend for you to do a little research. This is different from like other insurance or financial products you would buy. It does require you to do research. And the good thing about it is there's different ways to learn. You could either, if you like to read books, there's tons of books on it. If you like to listen to podcasts, there's a whole bunch of podcasts on this. And if you like to watch YouTube videos, you could also do that too. So I think it's important. You can also get on the phone with me for a free consultation. If you go to finassetprotection.com, you can book an appointment, a free consultation. So that's also a solution there too.
Cool. Hey, by the way, I'm on Amazon right now. Used Bank on Yourself book, $1.53.
Oh, wow.
A bargain.
Yeah.
So, there's the access to the information is effectively free. Get a free call with Sarry, buy the book. There's a ton of podcasts. I've listened to a bunch of podcasts. It's going to take you a little bit to get this concept in your head. Mm-hmm. What's your experience with your clients, Sarry? Give us a story.
Yeah, you're right. It does take some time. It takes maybe like from the day I introduce this to somebody on average to the day they commit to a policy, it could take about 6 months for that to happen. And there's also different phases. Like, for example, the first one is like the intro where I just explain it. And the second step is as a 90-minute confidential analysis. This is where it's just me asking questions, collecting information, and pretty much trying to get an idea of what the client wants to achieve. Not all policies are the same. Not all amounts are the same. So it's kind of a way to structure the policy based on the financial analysis. And the third call that we have, and by the way, about 100% of my work is done over Zoom, virtually in 50 states. So that's good too. So if you're wondering if I can help you in California or Florida or wherever you're at, I can still help you out. So the third call is a proposal where we structure the whole life policy we presented based on what was collected in the financial analysis. And then it takes some time for underwriting and for them to kind of get a little bit more questions asked. And then by that time, it's about 6 months on average for it to all happen.
Mm-hmm. Yeah. And as you mentioned, there's differences in like you said, policies, whatever, but also the approaches can be different too. Like we're talking about a lot of this use as far as, not only death protection, but in particular investing, right? But this is a powerful strategy that could be leveraged for maybe, long-term retirement or things like that, right? I mean, I've heard you kind of allude to this on another podcast episode. Can you talk about that a little more?
Yeah, absolutely. It could definitely be used. It could be used. So for example, you can have the policy, you can be using it throughout your real estate career, recycling your money. And then when you do reach, for example, age 65 or age 70, whenever you want to retire, you can start receiving monthly distributions from the insurance company at a guaranteed rate and tax-free rate too. So you can say, I'm going to fund the policy all the way up until I'm 65. And then when I'm 65, I'm just going to sit back. And for the next 30 years until age 95, I'm going to get $10,000 a month guaranteed. And of course, you would have to fund the policy. And it all depends on the age and the state and the company and how the paid up additions rider is all structured. But it is possible for you to structure it to the point where from retirement until anticipated death, let's hope it's really late, like age 95 or 100, you can get like monthly income coming in. And if something were to happen to you throughout the process, your family would still get the death benefit, of course.
And that's structured up front. Is that how I understand?
Yeah, it's structured up front, correct.
So that distribution later in life is up front. Now, okay, let's go back on the tax thing real quick. Those distributions, I thought they were growing tax deferred, but don't I have to pay taxes on those?
If you're using after-tax dollars to fund the policy, when you do go to take them out in retirement years, you don't actually have to wait till retirement. When you take them out in retirement, it's tax free because you already pay tax.
Okay, they're after tax dollars. Okay, so if we're not getting double dipped here.
Exactly. Yes.
All right, that's nice. Got to keep that in mind, everybody. Don't get taxed twice.
Yep.
John, I don't know about you, man, but my mind's kind of blown right now. Like, when Sarry introduced this to me several weeks ago, I just had heard of the concept of bank on yourself, right? Didn't really know much about it. And then listening to it and kind of doing a little due diligence leading up to the show here, like you said, it was like you hear the concept and you're like, man, this is a whole shift in the way that we think about, these types of policies and whatnot. But man, this has just been fantastic.
Yeah, and
great
Cody,
stuff,
I've got
man.
to say it. Again, for those of you holding a lot of cash, I mean, have a conversation, educate yourself about this. This is a potential alternative to not necessarily holding cash, but having it compounding, and then at the right time, you can exercise it to go invest in something. And, on top, you get the death benefit and the tax benefits. So, I really think about this, pivoting into one of these strategies. And again, you can start small, which is one of the key things I took away from this. You don't have to have $400,000. You can roll 20 grand in at one shot. And
or
then
you could do monthly payments, $300 a month.
Oh, that's what you're doing too. Yeah.
Mm-hmm.
Yep.
Mm-hmm.
Yep. Ton of flexibility. This is cool. So big recommendation. Everybody's, kind of educate yourself on this, listen to some podcasts and get on a call with somebody that knows about how to structure these.
Yeah, for sure.
Absolutely. Well, Sarry, man, listen, this has been a phenomenal conversation. Again, just completely opened our minds just to a whole nother avenue of just creative ways to build wealth and financial literacy. And so we appreciate all of the conversation and the great value that you brought to the audience. And, we look forward to continue learning more about this. So we're unfortunately getting near the end of our time here, but if you don't mind, tell the listeners how they can get a hold of you and learn more about you and banking on yourself.
Yeah, thank you guys. So you can go to finassetprotection.com. It's FIN assetprotection.com. And then in there's a link that you can just book an appointment via Zoom or over the phone. And all my consultations are free. So just go to the link and book an appointment with me. And I appreciate being on the show, guys. Thank you.
Hey, thank you.
Yeah. Thank you, man. Take care.
You too.
Bye-bye.
Bye.